Hello, and welcome to another episode of the Trader Stylist. If you're joining us here for the first time today, then this is a channel where I talk about how the commodity markets have performed over the week and also look at some other elements of commodity trading. And then sometimes I also try and see how I would position a trade looking at how the last week has panned out. So this is week three of the year 2024. And this is the episode for week 21, 1st of January 2024. Disclaimers, as usual, are that all views are personal and that commodity trading represents a risk of more than probably your invested capital. This is a scenario where you would be able to lose more than what you've invested. So all investments are definitely subject to market returns and definitely something that you need to watch a little more carefully. So hello, once again, I am Debajyoti, better known as DJ, and I'm here to basically help you craft your trade. So you can find me at the trade stylist. And as I say, may the trading gods be always with us. So this is again the slogan, may the trading gods be with us always. Um, Now we go towards the market update. This is how the markets have moved over the week. So if we look at Robusta to start the week, Robusta has been a star performer, 31.17, 5.8% up over last week. Arabica following slightly behind at 2.7% over last week growth. Cocoa London, high 0.1% up, and Cocoa US, 6.7% up as well. Orange juice also slightly above 0.9%, and cotton up strongly at 3.4%. But the biggest gainer of the week is probably sugar at roughly 9%. Then we have corn, which has dropped by 0.8%. This is and wheat dropped by 0.6%. Soybean barely holding on to the 1200 figure with a drop at 1%. Soybean oil dropped by 3.2%, and then soybean meal also dropped by 1.8% to close out the grains. YTD basis, we can see that all the softs complex except let's say a little bit of cotton are all positive, and cocoa, coffee very strongly positive, except for Arabica, which is sort of now the laggard in the sector as such. On the other hand, corn is getting more and more away from where it was last year, and wheat, soybean meal, soybean oil are also sort of following the trend. Now we go towards trade speak and we analyze what this trading week meant and what it looked like. So basically, Robusta, if you can see, the market has been moving up again positively. It's trying to gain its higher highs. And from right to left, which is basically the last trading day to the previous trading day, the last 10 to 12 days, we're seeing that it is being strongly motivated to go higher. Arabica, on the other hand, tried to find momentum in the middle of the trading days that we analyze, but at the end, while it still maintained a positive figure from where it started over the week, it has not yet come to the previous high of the week itself. Cocoa London, on the other hand, keeps breaking all records and keeps going up and up. And the last trading day, in fact, analyzed was the highest trading day of the week. Going ahead, Cocoa US, very similar to Cocoa London. Last trading day analyzed is the highest trading day. Orange juice, on the other hand, is barely able to hold on to a positive figure basis last week, and the last two trading days have been very muted in their performance, and that also shows where it is just holding at 0.9% up. Sugar, on the other hand, is roughly 9% over last week, and while it struck a pretty good high, it has been sort of maintaining this level over the last weeks. Coming to cotton, cotton again, the last trading day was the highest and it moved up by 3.4%. The entire trade seems to be that the cotton is again gaining momentum and looks to be at the current scenario that cotton might hit 90 cents again. Corn, on the other hand, tried to sort of protect and tried to sort of do a base forming. However, it failed after the WASDE report came out. and we had seen the impact of that with corn is back down 0.8%. Wheat similar, the bearish trend still continues and it's down by 0.6%. Finally, on the soy complex, soybean still down, barely holding on to the 1200 psychological level, but still down 1%. And we do feel that probably there is a chance that if the market does break this 1200 barrier, um, it can go further down significantly. Soybean oil, on the other hand, was trying to do a base formation. We had, in fact, thought of putting a plate on it. In fact, if the market had moved up, as we saw in the red bar, but after that it failed. The trade did not take place, and thankfully, that's the reason we trade momentums here, that it gives us a stronger direction and feel of the market. Soybean meal as well, complex going down, market at 356.40, down 1.8% over previous week. So now we look at the trader peak, which is basically the points of interest that are going on. And this week, this is basically the headlines of what is going on where. So Western Australia is in an extreme heat wave right now. It is definitely going to impact the crops and the climate that side. There's an impact of the severe snowstorm that the eastern USA is going to continue. And oil has dropped slightly over the reduced China demand, while the S&P posts another two-year high. A very interesting development in the EU is that Ukraine, Moldova, and Slovakia join the European Union's vertical gas corridor. And for readers who don't know this, um, the gas corridor is basically a setup where countries who are part of this arrangement can do a way or a two-dimensional uh, buy and sale of natural gas. So that makes them more resilient to outside impact, and sort of firms up their own internal structures. USA, on the other hand, confirms the first big sale of soybeans to China since mid-DEC 2023, which is almost a month since the last big sale has happened, which seems to be that there is some good news. There's some soybean bases getting traded right now at China. And then Musk once again has stopped shipment to Djibouti amidst the Red Sea issues. So these are the sort of the headlines which have formed up this week. What are the reports coming up in this coming week? Number one is the ECB interest rate, big thing to walk out. UK retail sales month on month, US personal income and spending. And we all know how much impact the US market has on the rest of the world. So this, I think, is something that I personally watch to look at how the trend is moving and what kind of disposable income would the US spenders have. And then finally, US GDP rate, quarter on quarter improvement, not improvement, we look at it. But the market seems to be quite positive if we look at the S&P overall. Now we look at trade deeper, which is diving into specific market conditions. This time we're looking at what the economy looks like globally, which is the world outlook. And this is basis Jan 2024. Now this comes out of the Chief Economist Survey, NOVDEC 2023. And if you look at almost 73% of the respondents are not very bullish on 2024, right? 53% somewhat weaker, 3% much weaker, and 20% unchanged. And that tells you that the bullishness in the market, strong bullishness in the market, just not exist. There is not a single percentage of much stronger response on this question. So going with this, what would be the economic growth for the different geographies? And the most interesting thing is Europe seems to be very, very weak. Similarly, China seems to be quite weak. Sub-Saharan Africa seems to be quite weak. On the other hand, the east of Asia and the northern African regions seem to be stronger. Central Asia, again, seems to be stronger. Latin America and the United States are sort of in the same basket, but the United States, again, seem to be slightly weaker compared to where it is. Overall, the usual drivers of growth, which is the United States, China, Europe, are seen sort of as falling back, with Europe being strongly negative and South Asia probably being looking at the strongest growth in this coming year. So what would be the inflation in this case? China, on the other hand, seems to be having the lowest inflation, which on a devaluing currency is somewhat of a surprise. However, sub-Saharan Africa, which we saw as being a weaker economy, probably looks to be either having a moderate to high to a very high inflation. Latin America, Middle East, Southeast Asia, Central Asia, Europe, all seem to be doing either moderate to a higher level. But sub-Saharan Africa, which is where we have a lot of issues of poverty, is also faced with probably the highest indication of inflation coming in this year. And that's going to be a double whammy. Looking at the year end, the pace of fragmented geoeconomic fragmentation, as we call it, would it accelerate or not? Most of the participants feel that most of the nations are going to try and protect their borders, protect their industries, and protect their trading environment. So this would probably be a year where instead of trade globalization, you would see a lot of trade barriers, whether they are phytosanitary barriers, whether they're economic barriers, or direct barriers in the form of physical barriers is something that we need to see. And part of it we are seeing where even the border nations to Ukraine are protesting against Ukraine grains coming to their markets because apparently Ukraine grain is far cheaper and they are discounting the market fundamentals and the market prices of the producers in those countries. And some of this kind of scenario is going to happen time and again throughout this year. We saw a rice ban coming out of India last year. There are multiple protectionist measures being put up by Sub-Saharan Africa to protect the national industries. I do think it's too little, but that kind of strain will only catch in strength as we go ahead. In terms of the volatility in the global economy, everybody expects to be higher. Uh, Localization of economic activity, stock market volatility, increasing geoeconomic blocks, which means more and more regional trade alliances. All of these are seen to be strongly likely. On the other hand, if you look at the increase in inequality and growing north-south divergence, ruptures in major global supply chains, this does seem to be decreasing over the previous economic forecast. And that is where there's a little bit of good news that typically the market does not expect the kind of disruption we've seen since pandemics or even after that during Suez Canal. And the Red Sea is a developing issue, but the market does hope that this will be resolved early enough. Finally, the weakness in the globalization of economic activity and investment flows is something we just discussed, and we do think it does impact overall, where globalization takes a second step and nationalization immunity takes preference over it. Finally, which are the industries which have a strongly positive outlook? IT, number one, mining, excluding fossil fuels, that is, you have medical healthcare, which is service industry, carbon energy industry, engineering and construction, utilities. These are all where the responses are strongly positive. Fossil fuels, leisure and travel, supply chain, manufacturing, financial, real estate services, retail, consumer goods are definitely seen as getting the most hit. Now, if we do a differential analysis, which is the number of positive responses minus the number of um, negative responses, we would typically see that the retail, financial world, manufacturing, and supply chain are among almost the worst hit. However, net to net, leisure and travel are also expected to get hit, and obviously because of that, the fossil fuel and energy is also getting hit. This is a surprise because airline fares and airline uh, of companies which have started sort of to returning back to profitability, especially after the pandemic, would then probably see increased competition and then would also see profitability going out and then valuations decreasing in this year. Looking at the next 3 years, people are definitely seeing that there is a lot of impact of the policy making going on. So people strongly agree that the policymakers will have to have trade-offs between stability and national industry. Again, there's an impact of industrial policies in increasing financial technological divergence or emergence of new economic hotpots. And even these kind of policies are actually create inefficiencies and lead to distortions within different countries. So the effect of these policies is going to be very hardly felt throughout. And finally, there is going to be an increasing in competing industrial policies, which means everybody is trying to shore up their supply chains, leading to redundancies. And while this seems to be slightly weaker than the other responses on this question, this still is a moderately positive to a moderately strongly agreed response. Finally, if we look at the joint industrial policies or defensive industrial policies, it seems that the market is going to look at defensive to crisis response industrial policies. Joint or a collaborative practice this time seems to be going or taking a backstage both in high income as well as low income economies, and which is what we impacted about or talked about in sub-Saharan Africa and probably also Latin America in the smaller nations. Finally, I'll leave you with this question. Considering that the pace of AI adoption today, when do we think that AI-enabled productivity is going to benefit or become economically significant? In the higher income economies, most of the people think is between maximum the next year to the next 3 to 5 years. And if we look at the strength of the response, almost 57% are saying within the next 1 to 3 years, this will always automatically become economically significant. However, in the low income economies, the same number is skewed towards 3 to after 5 years. And that also shows the scale and the speed of technological adoption in these low income economies. Can this be changed? Can this be an opportunity for these countries to shore up their economic value and their economic advantages? I definitely think so. Technological and upgradation is something that can be done. And I think the skilled workforce, which is immigrating to sort of the current developed world, uh, can also find tremendous opportunities in or basis AI coming to them. Moving on, we look at tradecraft. So of course, we analyze the trades that we did last week, what happened, if it did happen, if it's positive, if it was negative, and why or how, what happened and how do I expect to continue over the coming week. So thankfully, the first trade that we did propose has been up 6% since last week. So those who enjoyed it, awesome job done. Current profit is close to US dollar 28.40 per lot, and that's on just one lot. And I think it's time that you move the risk stop to 4,400 and then let it run. So last week we ended the week at around 43.15, 43.16. So basis that I took a position which is long positions, and this is sort of the profits I'm sitting on. Your profits would obviously differ based on the position that you would have taken. And I am clocking in roughly $840 margin and letting the trade run, seeing where the market would end up. And basically, my take profit would now be close to $4,700, closing in closer to on $4,000 overall. And soybean oil, no trade happened. The base formation was broken to the downside. So the setup did not execute. So there was no profit and low loss on the trade. And we expected a bullish scenario to happen if the market crossed a certain level. However, instead of crossing that level, it fell to the downside. So the setup was not even triggered. And which is why it's important to look at the trade triggers and place that while placing the trade and not just blindly look at the indicators or whatever charts or other kind of analysis that we follow. So what do we do next week? What is trade next? So number one is a new section we're going to add, which is about CONTRADEversy. These are about the trading stories, the trading legends and myths, which I think I found very interesting. And I'm going to talk about something which probably few of you have heard of, but it would be surprising for you to hear how deeply this impacted trade and how wild the tales were. So I'm sure you've seen The Wolf of Wall Street, but while they're trading about equities, I think we have, well, quite interesting stories in commodities as well. So we're going to talk about that in CONTRADEversy. We're going to focus on another important part next time is on risk management, and that's primarily about how to manage risk with low capitals. As a retail player, how do you manage risk? And that's very different from a risk management strategy, probably for a conglomerate. And finally, we're going to look at the market, see if there are some more opportunities coming up next week, and do some tradecraft. So I wish you all a good thank you for coming in from these very countries. And, and we wish that this makes some sense to you and this some adds some value to your weekend. And once again, the next episode goes out on next Saturday is the 27th of January 2024. Hopefully see you all there and hope you like it. Once again, may the trading gods be always with us. Cheers.